off the highs for the day, it's not considered a trend day. And this is important because when you go to the daily chart, right, every green candle is not a trend day, and every red candle is not a trend day. Certain days like this one, 26th of August, trend day. Open near the highs, close at the lows. The next day, trend day. Open near the highs, close near the lows. The following day, even though it's red, 28th of August, not a trend day, not a trend day, not a trend day, not a trend day, trend day. Open at the highs, close the lows. Trend day, open at the lows, close the highs. Trend day, open near the highs, close the lows. Even though this is not a trend on a daily, if you're looking at just the daily chart, if you're on an intraday chart, these are trends. These are not. Right? So you have to separate and understand that not every single day will be a trend. In fact, the majority won't. 70% roughly. So that is intraday. Swings. Let's go. Here's an example of some swings. I think I'm just double checking. Yeah, it's these ones. So like I mentioned, swings will have a catalyst. They will go for longer. They will be a combination of multi-day trends. And you have an example here of the Trump rally. So the assassination attempt was here, Saturday, 13th of July. And the market moved up for 16 days, rallied all the way up until Trump spoke at the Bitcoin conference at Nashville. That rally was, that 2-week trend was bookended by the same person with the same narrative, same catalyst. It was all about Trump surviving the assassination attempt. It was all about the hype because Trump was then being very pro-crypto. And if the pro-crypto president didn't get killed, that's obviously a good thing. And then there was actually an event where he's going to be speaking at, which is the first time he was going to speak publicly, I think, or second time he's going to speak publicly since the assassination attempt. So a lot of hype carried the rally up. After he spoke, guess what? The narrative was played out. The catalyst was now done. And positioning would have been overextended with too much chasing. The way you then trade that mean reversion, of course, is with the break of structure or market structure break, which I'll talk about in a little bit. Next one, rate cuts. So we all know the Fed cut rates a couple of weeks ago. And you had this move for 3 weeks in two parts. You had the anticipation. So price tried to go lower and it failed. So it recovered back from 53, got above 57, 58. And so you had a recovering market going into the FOMC. So some pricing in of positive developments because the rumors are coming out that they might cut by 50 basis points. That's going to be really good for the narrative. And then the Fed cut rates by 50. Then the market continued and rallied up, took out liquidity, went to the highs, eventually pulled back. These are examples of moves that do not lead to bull markets. Trump rally is not enough for a bull market. The Fed cutting rates is not enough for a bull market by itself. Now, this can develop into a bigger move, and I suspect it will, but it won't be solely because of the rate cuts itself. But the rate cut expectation and then the rate cut itself is absolutely enough to sustain a multi-week rally. Similarly, where we had the heavy selling, Germany selling here, no one person or entity can control the market. Germany decided to sell all the fucking Bitcoin. They were able to force the market lower for weeks, for about 4 weeks. Once they were done selling, guess what? Boom, back it goes, reverts it. So these catalysts, most catalysts will fall into this category where they will last for a number of days or weeks. And then the next one will build upon that. And if they're complementary to each other, let's say you get more bullish liquidity news, i.e. China prints more money, or the Fed cut rates again in November by 1 or 2 cuts. They talk dovish, they talk about supporting the markets, the economic data comes in good. That all feeds in to the bigger narrative which can be forming, which we might look back at 6 months from now and say there was a multi-month trend driven by policy. Right? You might see this policy-driven trend where it starts with the rate cuts, it continues with China printing, and it continues further with election and Trump winning or Kamala winning and saying we're going to fucking print shitloads of money, and away it goes. So it can all build into each other, just like a day trade, intraday trend can build into a multi-week rally. And it's important to understand these swings because the market always moves in swings. Even in a full bull market, it's going to go up for a week or 2 weeks or 3 weeks. then whatever drove that is going to exhaust. People will get too long. They will be over leveraged. You'll have a drop back. But as long as that drop back goes into a higher low, that's just a very normal bullish correction like you expect to see in bull markets. So those are swings, higher time frame, monthly, quarterly, or bull or bear markets. And of course, this is what you can all know as a classic bull. So you have a bull market, catalyst being this one, adoption, right? The catalyst for this was Bitcoin going sort of not mainstream, that was 2021, but definitely taking a massive step forward in its public consciousness, people knowing about it, people getting excited and hyped and buying it and telling their friends, and they're buying it, and it goes up and it keeps going up and it's reflexive, leads into this blow off top, and then you get the mean reversion. Comes all the way back to an area of inefficiency. So in this example, it came back to this particular area here. This is also a good example of what I said. Even though there's another gap here and there's one there and there's almost well, it does not have to, nor will it, go all the way back to the very start, because Bitcoin actually should be worth more than, $1,000. Maybe it shouldn't have been worth 20k in December 17, but also going down to 3k in December 18 was too far too fast, and you got the exact same thing again, where what happens? It bounced. Now this is a higher time frame rally. This would fall into the high time frame, this move here throughout 2019. Not a bull market, but a mean reversion. So the trend was also a mean reversion of the bear market rally or bear market decline. That's important to note too. One of the things I see confuses people is mean reversion does not mean that the market isn't trending. It's all about time frames. This move, quite clearly in the green box, this clearly, especially on a daily chart, is clearly trending. Higher highs, higher lows, breaking out, breaking structure, moving up. But when you zoom out and you see the context, if it's below the all-time high and it's moving up into previous resistance, and I've drawn this as a weekly order block, and it's moving up to an untested area of supply, a gap that is untested above, that is not a sign of a new bull market trend. It's a sign that the market's mean reverting. Went up too high, went down too low because of the extreme greed and the extreme fear, and that mean reverts. And when that one's done, what happens? Mean reverts again. Comes all the way back to where it started in that particular rally. So you have a full bull market followed by a full bear market followed by a mean reversion. And that's how markets move on a high time frame. That's why when you see something breaking structure, you want to look at above and below, where are the next levels? Because if it's no longer a trend, it's a mean reversion. Same thing happened in 2020. Broke out of all-time high, which is your best determinant of a bull market trend, is when it breaks all-time high. Because remember, technically, everything below there is just mean reverting this move. Even though the market was very strong with momentum here, technically anything below the old all-time high could just be retesting. Once it breaks out, full trend. Once that trend ends, comes all the way back. Does it in two parts in 2021. The first, it topped out here with very clear topping pattern, head and shoulders, Wyckoff distribution. Comes back and first mean reverts the 30k move. Moved up. You can see this more clearly on a daily chart. Right, moves up, breaks out with the Tesla candle. Whenever Tesla bought Bitcoin, trends, distributes, sells off, back down, mean reverts that entire move. We then get the second bounce, as you all know, go to new highs, and then the bear market proper begins, where it comes all the way back down to fill in the rally from before. So it mean reverts. And that mean reversion takes the form of a trend, which can happen and does happen. Then you get the exact same thing here in 2024. The first part of this, especially from the lows of November to the ETF launch, was just a mean reversion. It trended up, but it was just filling in the overextended, so went too high, went too low, comes back to some sort of midpoint. Then you get your second wave up to where we're at now, where we're just kind of consolidating. And whenever this rally failed or ended, where did it come back to? It came right back to mean revert that move, right back into this weekly untested area. That's why it's so critically important that it does not go below there, because if it goes below there, you're looking at where's the next area? Well, it's there. It's 40k. And if it loses that one, where's the next one? Well, it's 30k. It's 28k. And especially if that happens and you see this one, right, you're actually almost certain to get the other one as well, because then you don't just have one of them happening, you have a proper downtrend, and it's much more likely to mean revert the whole thing. So for the market to avoid that, what does it need to do? Obviously, make new highs, break out. That's why a lot of this talk at the moment it's still premature, even though I think it's bullish. I think we're more likely to go up than down. It still has to break out. And if you're looking at this last possible point where it could just be back and retesting, it's this weekly order block from 2021 that led to a massive decline and never got retested. We came up, we retested it, have went above it, but below it. We're trying to get back inside it. That needs to be fully flipped for it to be next uptrend beginning. Otherwise, of course, I don't want to think about that. So, the next part is trend failure. Yeah. So, here we go. What causes mean reversion? So, there's really 4 parts. I've already talked about it in stages, but I'll break it down. Ignition, that just means an attempt to trend. You can't have mean reversion if it doesn't attempt to trend. That's an impulse, that's a breakout attempt, that's a multi-day or multi-week trend, or even just an intraday trend. It doesn't matter. Market tries to move, then chasing happens, then it unwinds, and it all is based off of psychology. So, ignition, what does that mean? Remember, the market spends most of the time ranging, consolidating, rather than trending, because trending requires what? A massive amount of buying or selling in one direction, which is rare. So in those consolidating phases, price will consolidate, it will oscillate around a mean, right? So it'll have a level of which price is accepted. So for example, in the middle of last year, you saw a very clear, really nice range where between April and October, Bitcoin did not go above 31, it did not go below 25. So anything around that 28 was kind of the fair value. People are happy to buy around that level. They're happy to buy a little bit below. They're happy to sell a little bit above. They're not willing to buy above 32. They're not willing to sell below 24. And so it finds balance. So it's like a magnet. And then, because the tendency is to try and capture these moves, even though people know that when it moves to the high, right, when it goes to 31, people are like, I know this is resistance. I know this is the high end of the range. They will always try to anticipate trends. Instead of waiting for an actual breakout, they'll say, but if it goes to 33, I could have just got in at 30, so I'm going to buy at 30. What happens? People overposition, they chase. And when the trend fails to materialize, something like a false breakout, that sets up mean reversion conditions. So that's ignition. It's the attempt to move. So you have an attempt to move up. You then have chasing, which is people trying to all board the same train. If that train is not heading to fucking trend town, it's going to go back down. And that's what unwinding is. Because the big move, especially sudden moves, especially moves that happen really quickly and unexpectedly, like BlackRock applying for the ETF here. This is when BlackRock applied. It was actually on the 19th or 20th of June. And then we got this 3-day massive pump up into the resistance, into the highs. But everyone's like, oh, I know it's the highs, I know it's resistance, but it's BlackRock. ETF. What do we have then? 3 or 4 weeks of chasing as people try to build positions. The herd behavior intensifies as more and more people try to ride the same trend. More and more people think this has to be it. This has got to be the time. And then if the move doesn't get validated, if it doesn't get follow through, what's going to happen? False breakout, failure, falls back down, break structure, then you get unwinding. So unwinding is when that expected trend fails. Those who chase the move have to get out. And it triggers unwinding of positions. And then this is self-fulfilling. Once, it basically is a game of musical chairs. Smart people will exit fast. Less smart but still smart people will exit here. And dumb people will exit in the panic at the end. This gets into the last part. So you have the ignition, attempt to trend. You have the chasing, trying to follow that. You have the unwinding as the positions are overly skewed to one side. And then you have psychology underpinning it all. Mean reversion comes by market psychology. Right? When traders see that a trend isn't developing, they do one or two things. They either bury their head in the sand and hope that their eyes are deceiving them. So they ignore the false breakout, they ignore the breaker structure, they ignore the shifts, or they cut their losses quickly or take profit quickly and get out. You know how this goes. The smart people get out, the dumb people hope and pray and say, no, this has got to be it. I bought 31, I don't want to sell it at 29. Well, you're going to panic sell it at 25. So good luck. And this is where a couple of things happen. So mean reversion traders, the whole goal of what you're doing as a mean reversion trader is to anticipate that behavior. So as soon as you see the conditions of that failure, so the ignition fails and you've seen chasing, you want to get in as early as possible into the unwinding and follow that move. So you're essentially capitalizing on the poor positioning and poor emotions and psychology of the dumb money. It's contrarian, and it should be, right? Contrarian approach means you're going against the crowd. Now, it's very dangerous to go against the crowd because, like I said, in fact, every big trend requires the crowd to all be in agreement, or at least most of them to be in agreement. Big bull markets are bullish for a long time. Big bear markets are bearish for a long time. You do not ever be contrarian based on price. Ever. Never play mean reversion on price. What that means is never say it's too high, I need to short. It's too low, I need to buy. That's a one-way ticket to the poorhouse. Do not speculate on it based on price. Reversals and contrarian trading and mean reversion are entirely based on your data and your understanding of market structure. And yes, you can have an opinion about sentiment, but the market structure and the data is number one. So, you see it moving between overreactions at the highs, chasing behavior, breaks of structure in the opposite direction, and then you know that there is most likely going to be a reversion back to some kind of mean. And of course, you have to have that. So the example of the BlackRock move, you had this very clear area that was untested, these gaps that were left. So you had an ignition, you had an attempt to rally, you had an attempt to break out. You had chasing 3 or 4 weeks, all trying to catch the same, like this is 3 full weeks of everyone trying to catch this same breakout. Then the breakout fails. You know there's going to be unwinding to some extent, and you know the probable area to unwind to is where it began. Because it's mean reversion. That's how it works. It doesn't work every single time, but if you stick to the correct principles, it works far more often than it doesn't. You just have to be disciplined and understand your time frames. Don't confuse a day for a week for a month in terms of the trends and failed trends and mean reversions. But that's how it goes. That's how it works, right? So ignition, chase, unwind, psychology underpinning it all. Now, how do you actually trade it? What are some strategies? Number one is not number one, by the way. I've put this as number one because it's what pretty much everybody here has seen in bootcamp, because I mentioned it in white belt, which is range trading, which is what many of you will have known as mean reversion up until now. And it's completely mean reversion. It's absolutely a mean reverting market. But it's not the only way to do it. And I won't go into it because it's already in those lessons. The best way, really the only way that I would recommend trading a range is false breakouts, failed breakouts. The reason for that is because it covers what you need for mean reversion. If you want to set up a range and short the highs, right? So you're shorting the premium zone, the 75% and above, without it trying to break out. It might work sometimes, but it's risky because you don't have the attempt to break out. The attempt to break out is so important. When something attempts to break out from a range and then fails, you now have a really clear idea of where it can go. Because if it tries to break to the upside of the range and it fails, it's probably going to go back to the range lows. If it tries to break down from a range low and it fails, comes back inside, it's very likely to revert to the other side. That's why shorting the highs without it taking the highs and longing the lows without it actually going for a false breakout is risky. Because what happens very often in ranges is that they come down or go up or come down to an area and they will consolidate near it. So like if you're just taking like a range trade, for example, I'm just going to range high, range low. So the way you should trade a range is allow the range to form, wait for an attempt to break out, and trade either way, right? That's what you do. You don't do anything here. You wait for it to form. You see an attempt to break out. It fails. You get long there and you close it at the highs. You see an attempt to break out. It fails. You get short there and you close it at the lows. It's tempting when you have a range to see it do this, right? And then try to like go long here. Because you're like, well, that was support before. It's going to be support again. But so often what happens when it's near the lows is actually it's just consolidating before an actual breakdown. And, or, exact same thing, your impatience by trying to get long here just means you get long before the actual false breakout and you get stopped out. And you would have got the trade anyway. Instead of longing here, you wait and you long there. So there really is no better way to trade a range than some kind of failed breakout. So I would strongly recommend that. And I would encourage against trying to overtrade ranges by continually trading from range low to range high. Second, trend failures. This is also this is the same as mean reversion range trading in one sense. All a range trade is with a failed breakout, all it is a trend failure. It tries to trend, break out, it fails, so it reverses. But the difference is you don't need a range to trade trend failure. You can just trade anything that is a failed attempt to create a trend. It doesn't have to be a horizontal range. It can be any failed trend. So, trend failure, I'm going to show high time frame. Here we go. 2 in a row that happened last year. Large moves lead to chasing, like I mentioned. If not trending, will return to origin. So I've already covered this one. And I'll just zoom in on it here a little bit. You have your attempt to break out, failure. Comes back inside. You have a market structure break over here when the swing low breaks. The swing low that led to that high breaks, MSB. In the red box is where you should be looking at shorts. Unless it can do the black path. If it doesn't do the black path, it's going to go where? Back to the origin. I've just drawn it as an order block because I want to keep it consistent. But obviously you know these lows as well. Up to you to decide where your targets will be. In this box, if you're at high, well, regardless of time frame, but this is a daily chart. If you're doing your high time frame analysis and you wake up and you see the Bitcoin chart here on the 29th of July, 2023, your only view should be, I have a focus towards shorts unless price is able to go up to those highs. It has to reclaim that level. So the failure level, unless price reclaims that level, everything I'm seeing here, up, down, sideways, doesn't matter. It's going back to here. That's your view. That means it could do all this. It could go here. It can do that. It can absolutely do it. And it's still going to go there. It doesn't matter. It could go down to there and bounce all the way back up. And it still goes there. Until price fills in and goes back to the origin, your view on this would be short unless it reclaims the key level. As soon as that move happens, it unwinds very fast. What does it do? It leaves behind another inefficiency denoted by the order block. So leaves behind an attempt to break lower. So this move was an attempt to trend to new lows. So it has a break, leaves a gap, leaves behind an area that can be mean reverted into. Price then tries to break down a couple of weeks later, a failure. After the failure, you get what? A market structure break here. Then in the green box, you're long focused. To where? To the inefficiency getting filled. Price will revert back to the origin of the move unless the failure level reclaims. So unless price did this and got back below here and started to trend again, unless it does that, your view is it's going here. And I've drawn a few other ones here just to explain. Trump pump, left behind an inefficiency, so it moved up, tried to go higher. Trump spoke at the conference. It then what? MSB here. Boom. Market structure break. As it breaks the swing low that led to the highs, breaks the market structure. If it cannot reclaim that, then this is exactly how you view it. If I wake up on the 31st of July and I say, if price cannot get back above, this is why you'll hear me say stuff, and I sold my Bitcoin on one of these days on the Friday, part of that reason. But you'll see me say, if it can't reclaim 68, it's likely going to 58 or something like that. That's always based on something like this. It doesn't tell you, you must short now. You would have to use a strategy, which I mean, once you've seen the MSB, you're looking for short entries, right? But you say, because of market structure, if this market structure is broken and it's a failed attempt to trend, right? Clearly, we're not in an uptrend. It hasn't got above 73. It's trying to get there. It's putting in a reversal. It's failing to trend. So the ignition, you've seen it. Ignition has failed. You have chasing, absolutely, because we had the Trump assassination attempt. We had the move up, rally, chasing. A lot of positions being built here into resistance. You then see the reversal, first sign of reversal, and then you have the unwinding. And the unwinding takes you back to at least that area. Of course, this one goes way below. Doesn't matter. It's not supposed to magic boing from there. That's just your first target would be where the move began. Because the only way a trend, right? A trend moves like this. It doesn't pull back fully, yeah? That's a trend. It does not come back to the prior lows. That's how it trends. It makes higher highs and higher lows. If you have a trend, an attempt to trend, right? If you have an attempt to trend that does not, right? You have a failed trend. Where's it going to go? All the way back. Why does it go all the way back? Because it's not a trend. If it was a trend, then it would come back and form a higher low. If it is not a trend, it's going to go right back to where it began. Hence the origin of impulse being so important. You then get this move down, where from the highs, it tries to break lower, right? Tries to break the new lows, in fact forms a higher low. What happens? MSB, so you wait for your market structure break over here. If it cannot go back down and go below that level, it's going to go where? Into here. There's your mean reversion. Boom. Exact same thing's happening as we speak. You have the level where it broke down from. So this is an attempt to start a downtrend. We're in an uptrend, at least on the daily. It's an attempt to start a downtrend. It's broken structure, right? MSB, swing low is broken. It's attempting to go lower. It's consolidated. Now, failure, tried to go lower. Followed by, probably today, we're going to see a market structure break. There's the high that led to the low. So we're probably going to have an MSB. After a failure to go lower, where would you be looking then? You'd be looking towards mean reversion. So if it closes here today, the view would be that over the next few days, it's going to make its way there. And because we potentially have a primary trend beginning, it might even go higher. But that's irrelevant for this point. The purpose of this, if you're trading it, is just if we close above this dotted line today, my view would be that I want to take longs until this retest happens. And so you trade that on a lower time frame, build your system around it, all of that. That's high time frame trend failure. Here's medium, which, there's no such thing as medium time frame. It's not like it has to be a 1 hour chart. It can be anything. It's just not a day trade because it takes longer. And it's not a multi-week trend. So here's an example. Obviously, this has not happened. This is just an example. That if you were to see, after this large move up that we saw on Friday, with loads of gaps left behind, and very clearly a chart that needs a retest of the lows, order blocks everywhere, inefficiencies, do you think there's not going to be chasing here? Absolutely. Ignition has happened. Chasing is currently happening. Look at meme coins today. Everything's pumping. Weekend pumps. Could you get anything more scary for a bull? No. If it fails to break, you do not short this now. If it fails to break and then it breaks this swing low, your expectation at that point is we are likely mean reverting back to at least 60.7 unless it can reclaim that level. I can't stress enough how this should just become, even if you don't trade mean reversion, this is probably the simplest way for everyone to analyze the market. That if you just look at, do we have some attempt to trend? If so, where would that fail? And if that happens, where would we mean revert to? And don't worry about trading it. This can just be your market analysis. Like the exact thing I would say, because we took those highs, by the way. So we did grab the stops. My exact message would be, failure to go higher. If we close below 62.4, right? So if we see hourly closes below 62.4, I would say it's more likely to go to 60.7 unless we can reclaim 63.4. That's it. That can be your journal entry for the day, and you can just watch. And if you have trading systems, they should be only looking for shorts until that level's hit. And if you're looking at longs, it's after a reclaim, right? Or obviously, a sign of reversal in the other direction. If you see the same thing happening, then you're looking at longs again. And medium time frame, here we go. Yeah. So again, we get a move up. And we see here. So you see this consolidation, breakout. There you go. Ignition, price attempts to trend, moves up into the highs, chasing, right? Follow up, 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 fails to break out, comes down, consolidates, breaks down here. So it's over here. Once you see that structure break, where are you looking at? Reversion. Because this is at this point here, should say over here. At this point here, this is the earliest point at which you know that this is not a trend move anymore. The attempt to trend has definitely failed. It doesn't mean it's definitely going down. It means it's far more likely to revert back to where it came from. Then we go and we break down once more, yet again, and we have this setup from, I think, last week, where you see price go down and try to go lower and try to go lower. So you have 3 attempts to push after an aggressive down move. So you have an aggressive down move that leaves behind gaps. You have an attempt for a downtrend, as you can see. You have an attempt to break lower. You have chasing because the market's moving lower and has moved lower from all the way from what? 66 all the way down to 60. You have chasing the move, failure to go lower, market structure break. Once that happens, once you get your first significant swing high breaking, target is where? Mean reversion. And that's obviously what we see right there. And is there any more on that? I think that's it. Yeah. Now, low time frame, intraday. Here's an exact system idea for all you day traders. Really good one I like. Doesn't happen super frequently, but is very good. So, intraday trend failure looks like this. Daily open, daily close. What is this? A trend day. Yeah? Opens near the lows, closes near the highs. Price trends up. In these examples, by the way, in these instances, it's actually not a bad thing for the trend day to be weaker. So you'll notice this. I'll explain. You'll notice that it closes here, and there was the high, and it opens here, but there was the low. So it's not like it was a really strong trend. If it was really strong, it might have dipped a little bit and rallied up and closed there. That would have been a very strong trend day. That's when you expect continuation. This one was definitely a trend day. It went higher and it trended into the close, which is important as well. So the end of the day was higher highs, higher lows right into the close. But it closed slightly weak, meaning not super strong, not right near the highs. Maybe 60% of this day was up when you take away the lower and the upper. If you're looking at the candle, if you look at a daily candle, there's probably 60% of the daily candle is a body and 40% is wicks. That's how you would actually measure this. And the very next day, what happens when you have an up day? What happens when the market's green? What happens whenever the market closes green and you've seen it go up all day? How do you feel? Reflexively, typically, you feel like we're going to keep going up, right? That was a bullish day. Tomorrow's probably going to be bullish. Then what happens? Not that. Early in the next session, typically, right? It's best if it's early. A failure to follow through the previous day's trend equals mean reversion. All this means is it tries to continue the previous day's trend, that's up in this case. It fails to. Then you get a structure break. Again, you don't short just because of that. You get the market structure break. You expect mean reversion. Everything in the red box, you're expecting it to go back to where it came from. 2 targets for this. Previous day's open. Previous day's low. One's a liquidity target. What does it do? It comes right down, sweeps out yesterday's lows. Or it goes back at least to the previous day's open. Because that would mean the trend has fully reversed. If it goes back to the previous day's open, there is no trend. And that's that. Now, wait a minute. So there's trend failure. High time frame, mid and low, intraday. Next, reversal candles. So just individual candlesticks. I'm not really a candlestick trader, but there is a very simple way you can use them. And that's to take the reversal candle and expect price to go to the closest gap and fill it, or a significant gap. What that means is you have a bearish candle, so in this case a bearish pin bar. Price then moves back into a gap fill, right? So the example of this is like on a 4-hour chart. You would obviously trade this on a lower time frame. So you would use multi-time frame for this. But the bearish, and this is where you want to you use your primary. If you remember last week's lesson about EMAs, talked about primary, secondary, tertiary. If you're using like a primary trend for this, the primary trend is where you get your candle and you get your gap target. So you pick the candlestick on a 4-hour, you find your gap on a 4-hour. You then trade it maybe on a 15-minute, just so you can get a better entry, and you can maybe use 15-minute EMA bands or breaks of structure or whatever, moves down. That's all that trade would be. I know it goes lower and does a lot. The idea of this pin bar is not that it's magic and goes to zero. It's that it is a sign of reversal. If this is an attempt to trend, right? If this is ignition, if this is the market trying to trend and you get a bearish candle, that attempt to trend is going to fail more often than not. So that attempt to trend fails here. It doesn't mean it's going to go to a downtrend. That's a separate thing entirely. The part you want to trade is that little bit in between. Same thing here. We're in a downtrend. You get a super strong bullish hammer. Could not be better. Big long wick closes right at the highs of the 4-hour. Your view then is, where do we try and break down from? We're going to fill that gap. Boom, grinds up, fills the gap. By the way, don't be worried if these gaps fill slow. This is how mean reversion works. It is going to be slower, which, by the way, should help a lot of you, or everyone, because it gives you more time to act. Right? There's no rush generally to get into these trades. You can see here, when it closed, the next 4-hour candle you could have get in, and the next one, you could have got in here, you could have got in there, all at the exact same price. There's not generally a rush. The reason for that is because that's how markets move. Markets move, a failed attempt will impulse fast and it will fill slow. That's classic mean reversion. That's why you see these. That's why you see this all over the charts. Impulses in 3 candles. Takes about 20 candles to fill it in, but it fills it in. So mean reversion trading requires patience for sure. It requires you to not panic or second guess yourself and stick to your plan, stick to your systems, because of course it takes a lot longer, right? This hammer happens on Friday. It doesn't fill until Monday. But that's fine. You're not going anywhere anyway, are you? That is from an old lesson. So those are reversal candles, GM. And last one. There's a million more, but as with all of these, I'm already an hour and a half in. I knew this would be a long one. There's loads more. There's going to be a mean reversion 3, no doubt, in the future. Mean reversion strategies. Number 4, no second test. My personal favorite of mine. I fucking love this because it plays off of the simplest, most reliable form of chasing. And that is the first bounce. Here. This is pure psychology. What happens when you see a fast move down? Panic. What happens when it bounces up? Shit, I missed the bottom. What do you do here? You overexpose and get long. What happens? It comes back for a fucking retest. I did a daily lesson on this. It's called retest, retest, retest. Search it. Retests are so common. Not 100%, nothing is, but well above 50%. When you see markets move off a low, on whatever time frame it is, this is a 5-minute. This could easily be a 1-hour chart. Doesn't matter. It could be a daily. When it moves strongly off a low into resistance, this is important. Like, if this goes here, right? If that goes to there, well then it might just be trending up. If it moves into resistance, then has an MSB, this way it moves into resistance, has a market structure break, you should be saying what? It's going for a retest. I either want to wait and buy the retest if I'm going to get long, or I want to short with a direction towards that retest. No retest. If you see the market hit a low or hit a high, have a reaction away from it into resistance or into support, expect it to go for a retest. That's how they happen. It's just, this is like, whenever you see big liquidation candles, people always like rush into long the first time, and it's so fucking dumb. Because how many times have you seen this? Right? How many times have you seen this exact pattern? Everyone rushes to get long here, and it goes lower again. And rushes with these big, I need to get long, and get long again. And then what? They rush to get in here, goes lower. Rush to get in here, goes lower. 3 pushes, I have a lesson about 3 push reversal, sweeps, multiple stabs lower, whatever the fuck you want to call it. These are just retests. Even though they go slightly lower, this is obviously the bottom. So these are just retests. Markets almost never bottom on the first wick. Sometimes they top on the first wick. That's because in crypto, there's a far greater tendency for people to FOMO in at the bottom. Meaning, the first bounce, they get long. I need to get long. Whereas at the top, there's usually not that many people willing to sell. And they're not actually going to short on the way down. They might actually even long. Because crypto has a long bias. So that's why you can see, tops like this. I mean, technically, I guess there was a retest. But this just pulled back all the way and just all the way down. So, that's intraday. No retest, you should be looking for one. And yes, absolutely, which is why, what have I said since last night, even though I'm bullish? Yes, this is a chart without a retest. There are some lower time frame levels that have broken. Fucking hell. There's some lower time frame structures that are broken. It's definitely reclaimed this area here. But this is coming back for, in my opinion, in my book, in my systems, this is coming back for a retest. I don't know when. The clear invalidation would have to be, first, if it closes today above here, it's a Saturday, kind of sketchy, closes above here, that is a market structure break, so maybe the retest will take longer to come. There is a chance the retest never comes. It's just not a good bet to make. Right? It's not a good bet to make because retests almost always come. And you're not playing for, but what if this is the time? If you say that what if bullshit, you're just going to end up losing all your money. Because you can always delude yourself and say, but what if this is the time there is no pullback? No. There's almost always a pullback. So if 80% of the time there's a retest, does that mean you try and catch the 20% that aren't? No. You always expect a retest, and you accept that 20% of the time there's going to be no retest. And you have to find an entry somewhere else. So what that would look like for BTC here, my expectation is this. I think we go back down for a sharp move. By the way, I think it then goes to 66. My guess is that we do something like this, right? That we make our way down really fast, maybe at the start of the week, into a retest, and then we rally hard again to the highs, and then we go back for more chop. Because again, this is just ignition. We've had the ignition. Chasing. We've got chasing. Are we going to get a flush? Which is a mean reversion. I think so. But if we didn't, you've got levels in between. There's an MSB, right? There's the high that led to the low. Maybe it pulls back and forms a higher low here, and you get a bullish under over. Well, boom, let's go. Fucking, then it's a bottom. Maybe it's just a head and shoulders inverse, right? You don't have to expect it to go all the way back down, definitely for sure. But most of the time it will. So your assumption should be that it will. You should never think it's a certainty, because nothing is. Another fucking great one. So any of you who aren't day traders that are worrying and wondering, shit, I don't day trade, here's an excellent one. Intra-week. No retest. Whenever the first move on Monday, basically Monday's high, there's a drive on Monday. It doesn't have to be early. This happens to be. It could be any time on Monday, and then you have a sell-off. Or, in reverse, if this was a down move, and you had a down move, and then come back into this here, you should be looking at a retest at some point later in the week. So how that looks here. Monday starts with a drive up, drops back down, consolidates. So, Monday, people start off bullish. Oh shit, we're wrong. Comes back down. Tuesday, oh, this looks like shit. It's bearish, going to break down. MSB, remember, you don't get long anywhere here. You wait. We have attempt to go lower, breaks above, comes back, retests. It's obviously choppy price action, but there's a market structure break here. It actually comes for a retest of that low. Holds. Where does it go? Retest. Because Monday left behind, essentially it left behind inefficiency. And it's very, very unlikely for Monday's high to be the high of the week, unless you have a really strong trending week, in which case it tends to go lower and you maybe end up coming back weeks later rather than in the same week. If you have an attempt to pump on Monday and price comes back and doesn't significantly break structure from the previous week, right, comes back to support, it's going to go retest that Monday. So your intraday or intra-week bias, I should say, for your swing trades that are 1 or 2 days or whatever, should be long. Exact same in the opposite. Intra-week, no retest. You can also do this off the daily open, exact same thing. Off the daily open, no retest. You get a pump on the daily open or a dump off the daily open, exact same thing. If you go to a 5-minute chart, where's the daily open? I mean, this happens multiple times per week. It's just that it's not always tradable, right? So here, perfect. The reason why it's not always tradable intraday is because if the move's too small, you're going to get eaten up by fees. But what do we have? In the first hour of the day, what happens? Pump. Leaves behind a big long wick, drops down, looks bad, looks bearish, but does not break lower. What happens then? Starts to move up, starts to move up, move up, move up. Where does it go? Retest. Again, this is not one you would, I would say it's probably not one you would trade because it's quite a small move. Maybe, depends. Run the numbers. You have to be able to account for fees in this. Intraday small moves are going to cost you more, but definitely a valid strategy. Off daily opens. I mean, it wouldn't even take long to find another one, but I think you get the idea, right? This, by the way, yeah, here, okay. This kind of one is interesting because you have the daily open, right? You have an initial move and then a move away. You're like, oh, untested low, right? So moved away, no retest. It was a retest, though, of Wednesday's move. If this had swept the lows, I'd be more inclined to say it might not come back. Because it didn't, the fact it comes back later for retest, no surprise whatsoever. But there may be ones you'd avoid because it could be just a retest that one, maybe go higher. In any case, you just wait for clear signs of reversal and trade it. So, and monthly open, exact same thing. So if you're an even higher time frame trader, exact same thing. This is fractal logic. It works on a day, it works on a week, it works on a month. We've had this a bunch of times. Where's August's open? August just opened straight up with a dump, actually. Where's September's? I'm trying to see. You have to see a move on the first part of the month. So here's September. Initial move down, then a move up. Yeah, so you can see it here. It takes only 2 days. It's more of an intra-week move. But you can see here. Where the fuck's Sunday? Oh, sorry, here. Initial move down comes back to the monthly open. That's not a great example. It's not a great example. You want to see a pretty clear move. Let's take May, for example. Left an untested area. And that one came back in July. So, here we go. Where's my line? So, in May, if you'll all remember May, it was brutal start and a nice end. Right off the open, at the beginning of the month, we saw a move down into a low. So, on the first day, which probably I should show it on a daily chart so you can see it better. On the first day, you left behind an untested low. The first of the month, even on the second it didn't get swept, moved away. So, you don't say this has to come back to May's open, May's low, so I'm going to short it. You just let the market move. But when the break happens, right, when it fails to break out at 73, and then you have a break structure, and then the market's trending down, retest. That's your area, right? It's going to come back to the monthly May open. It's an untested area. Comes back, retest, but goes below it, but that doesn't matter. It could double bottom, it could do anything. So you can apply that logic over and over, in a day, in a week, in a month. It's no second test. And that is it. Done. GM. You're right, Nick. That's definitely the fucking longest weekend workshop. It was a good one. Hope you enjoyed. Fuck questions. I really don't have time for questions. That went way longer than I was expecting. But let's go. I'll answer quickly. Hungry Hugo. When should I look at volume? How good of a confidence does it give? How does daily open affect the day in terms of mean reversions, worth taking and overextensions? I covered that second part at the end, or within the lesson. Volume, you can always use volume. Volume's just volume. It's not like by itself, it's not good or bad. It's about the context. You'd have to apply it in a system and test it. Illuminati, does this look like a valid range you trade for Pepe at this time? 15-minute time frame? No, it is mean reversion. It's consolidation. It's not. I strongly suggest not range trading meme coins on a low time frame in a trending market. If you look at Pepe, it's above all its bands, 50, 100, 200. They're all bullish. Trying to range trade this, just in general, Range trading altcoins defeats the purpose of altcoins. Altcoins exist as beta to Bitcoin, meaning they're more volatile, so you can have a smaller position size and get higher returns on them. Obviously, there's more volatility, but if Bitcoin goes up 10%, there's probably going to be a coin that goes up 30 or 40%. If Bitcoin goes up 100%, there's meme coins that went 10x. Memes exist for trending. You buy spot meme coins because it's like a levered Bitcoin position. Right? It's leverage without leverage. That's why using leverage on altcoins is retarded. They're already fucking hyper leveraged. XPark, the 6-7 months we've seen Bitcoin move, is it mean reversion or trending? Mean reversion. Mean reversion, absolutely 100%. Brunsea, GM. And I talked about this a bunch of times. Even though it's making lower highs and lower lows, the reason why you class it as mean reversion is two reasons. Number one, look at the weekly. Right, so the weekly is just pulling back into... The weekly swing low is here, right? So the market structure on the weekly is actually there. This, if you're just using straight up market structure, that's the swing low. Until that breaks, this is a trend. Now, obviously, if it goes all the way down there, it's not going to look great. But if you're taking market structure, that's what needs to break. So it's in a weekly trend. And because each time it tries to go lower, it's mean reverting almost fully, meaning it's 70, 80, 90% retracements. That's unlikely to be a trending move. If this was a downtrend, you would not want to see 80% reversions, right? That's unlikely a downtrend. A downtrend should look like what? Down, 40, 50, 60% bounce, down, 40, 50, 60% retracement, down, right? It should be shallow retracements or shallower. Fractal nature of the market. Brunsea gets into my head and I start going crazy. There's a range and a range and a range. There's track of all of them. Don't know how you should treat them in relation to one another. The lesson covered that. It's all about time frames. You're either so maybe don't think about 1 hour, 4 hour, 15 minute, 1 minute, 1 day. Maybe think about what I've said there. Intraday, intra-week, high time frame. There are your three. And building a system around something like, okay, there's a Monday open or a Monday drive that's untested, right? So Monday had a pump or a dump, it's not been tested. My only view this week then is if there's a mean reversion trade towards that level, I will take it. If it's intraday, again, I'm only interested if there is a trade that meets the criteria of this system. So with ranges, obviously ranges can form anywhere and you can draw them anywhere and there's all these different time frames. But applying a little bit more context to it, like I've shown in the lesson, should solve all that. What you want to do is have fewer things. So everything I've shown here is not all the things you should put into a system or have. I've tried to show a broad range of 4 different types. Well, 3, I didn't cover ranges again, but range. There's ranges and there's the other 3. And I covered it across multiple time frames, low, medium, and high. You don't have to do all of those. You pick. Okay, I'm going to focus on this. So this is all I have to look for if it's intraday. I'm going to focus on this if it's intra-week. So it's all I have to look for. And so on and so on. And as well, if you're predominantly a trend trader, this lesson is perfect for you. You just don't have to trade it. You can just look at this lesson, take it and the bit I mentioned earlier about the analysis and say, I'm going to analyze it and understand that if X level breaks and this is an MSB, then me as a trend trader, I can't look at longs because the market structure is broken. And it's more likely to go to 53 because it has broke this one unless it gets back above 64, right? So you can use it just as a high time frame bias. I don't want to say bias, but it is a bias. You're like, because this structure is broken, the bias is to the downside unless it reclaims this level. That doesn't mean you develop a bearish bias and you start posting stuff about fucking 1929 fractals and sharing Bobo the Bear memes. It just means because this objective level on the chart has broken, my inclination is for more downside unless it is reclaimed. Understand? Good. So, D-Bolt, no. The daily open is midnight UTC. 0000 UTC. That's the daily open. There's only one daily open. That's it. YHWH. Does the New York Open usually follow the daily open? Does the daily fails break out? Reverts. You can tell me that from the testing. Aladdin, GM. Are there signs that indicate when the range is ending? Just the ones that are mentioned in the range trading lessons. A range ends once when it breaks out. That's all. Of course, you can have breakouts that fail. You get the idea, though. G, Nuxec, can you show an example of mean reversion based on the current price action? 15-minute, 1 hour. Already did. I did that literally with the exact thing that's forming on Bitcoin right now. So if that plays out and Bitcoin breaks that structure, then mean reversion. Why using wicks on the upside as MSB and close on the downside? For example, trend failure MTP. I think you're probably mistaken, unless I've made a mistake, which is impossible because I never make mistakes. I'm joking. This is not structure. So this part is not structure. This is the wick. When you're looking at a failure to break out, the breakout can only come above the highest point or below the lowest point. It can only be a breakout if it goes above there. But for a break of structure or a market structure break, it's closes. Because when you look on a line chart, right? For market structure, the best confirmed trend shift is when the close breaks. But to the upside, where do people buy and sell breakouts? They buy and sell breakouts above the wick high or below the wick low. So, yes, you're correct, but I'm not using it for market structure on the upside. It's liquidity. It's the attempt to break out. You can't have a failed breakout unless it actually tries to break out at the highest or lowest point. GM, K. Gill, Dragic, in the green area, recognize the same pattern, failed to go up as expected. What's the difference there, and how can one filter out the failing one? Intraday, no retest. Was what pattern? What pattern? I don't get it. Do you mean that it closed above here? Right, so that it bounced and it came back for retest even though it closed above, you would have expected to not come back? Well, you wouldn't trade it, right? This is why you would never have taken this trade. If you're talking about, would I have shorted this back to the lows? No, because there was never a market structure break. It came back. Would I have longed it? Again, this isn't a long trading system, right? So you wouldn't have took the trade. Do you understand? If your idea is that this is going to come back for a retest, you either take a short or you don't take a trade. Even though it breaks structure there or MSB's there technically with a close, that's fine. That's not the trade. That's not the system. You're waiting for the retest. Unless you mean something else, but I think that's what you mean. Rich Bros, how would we define objectively resistance? The one you used on the no retest strategy? You don't have to. You don't have to be objective with it. You can actually be subjective with it. Because your rules are objective to actually enter. So where's the no retest one? Where the fuck? I think I've wiped it, have I? I wiped it. Where was that 5-minute chart? Too many charts. All right. Here. It doesn't need to be objective because you can say, if you want, you can say this is resistance, just right at that level. That's fine. So from the breakout point, if you want to make it just simple objective, swing low and wick, right? So the swing low, that was where the BOS or the structure break happened on a candle close basis. The low, the liquidity, when that broke, you can use either of them. It doesn't matter because as soon as one of them gets hit, you still wait for a market structure break. So it's only after you have the MSB that you would action a trade anyway. So you can have a zone, you can draw an order block, you can look at the wick, you can look at the candle close. It's because, and this is how everyone can make market structure or support and resistance, how you can make it more objective. You never need, you can draw literally anything because with time, you'll just intuitively start to understand the support and resistance better, right? It's like, I know that this general area here is resistance. Why? Well, it pushed into it, it failed it needs to come for retest. So that general, I can say that's resistance. What I don't do is I don't short here. What I do, or would do, is I would wait for it to go into it, then have a market structure break, and then short it, right? Only after you see the MSB, after it's hit resistance, then do you short. And resistance can be anywhere. Support can be anywhere. Understand? I get that it's confusing, but you can make it objective with like candle close, BOS, a wick, an order block, or whatever. But as long as your price action trigger to get in is objective, such as I wait for an under over or a reversal pattern or the bands to turn red, whatever it is, then you're all good. Few, with the trend failure system, you show daily open, low work, instead daily close. You look at New York open, and we find a mean reversion in session. An example below. Hold on a minute. Would the trend failure system show with the daily open and low work if instead of daily close, you look at New York open and find a mean reversion in the session? Oh, bro, I don't understand this. There's too much going on here. So daily open, New York, daily open. Yes. If what you're saying is in the New York session, you get a trigger to mean revert towards the daily open, totally fine. Yes. If that's what you mean, that it opens, we trend down until New York. In New York, there's a reversal sign and there's a reversion to the daily open. Absolutely. And that is it. And I have to end. This is 2 fucking hours. GM. Thanks for joining, everyone. Hope you enjoyed it. Recording will be up after. It'll be up for 24 hours or more. And tomorrow we'll do weekend workshop. No, we won't. That's today. Tomorrow we'll do weekly outlook. Thank you all for joining. GM. Talk soon.